Welcome to the Mind Money Spectrum podcast, where your hosts, Aaron Ogti and Trishul Patel, go beyond traditional finance questions to help you explore how to use your money to achieve the freedom you want in life.
Hi, my name is Aaron Ogti. I'm a financial advisor in the Bay Area, and I'm here with Trishul Patel, a wealth manager on the East Coast.
Hey, Aaron, great to be here today, and thanks everybody for listening and watching.
For listening and watching, I like that. So today we are going to get a little bit wonky, and what I mean by that is we're going to try to explain math via podcasts. And while the math isn't that complex, I do acknowledge that it might be hard to follow along auditorily and visually. So we're going to try to take our time and explain what we're doing as we talk about this. And it's very likely that I will go off track. So I'm going to hope, Trishul, you can keep me on track today. And I'm sure I can stay kind of cogent and lucid, but make sure people actually understand what I'm saying, because I can easily confuse myself with going in circles on this. So try to keep me on track.
All good. I'll do my best because this will be a big refresh for me. So if I'm not following you, then we'll find out quickly.
Okay. So earlier in the year, I wrote an article on my website about the Netflix employee stock option plan. I've written about this in the past, and they have a unique plan. It's actually not the point of today's conversation. It's that they have a plan set up so Netflix employees can have options, 10-year stock options in a publicly traded company. And I was trying to help the employees understand the math behind when to exercise and sell the options that they already have. So a little backstory, they introduced this plan several years ago. They allowed employees to contribute even more money in 2000. I think it's 2000. So employees were putting a lot of money in 2001, 2002. Stock price got pretty high in 2001, then dropped in 2022, 2021 to 2022. And then the last year, it's actually come back up from some of the lows in 2022. And so all of the options that they had from 2021 are still underwater, but the options that they purchased in 2022 actually do have some value. And so I was getting questions of, should we cash out and kind of collect our money from the options we had from 2022? And these dates are relevant because we can kind of track what the stock price was at that time. But I'm going to try to apply the same conversation I had with the Netflix employees to non-qualified stock options in general. As if you have a stock option, especially as an employee stock option, has a 10-year expiration, how do you decide when to cash out? How do you decide when kind of the stock has gone up enough that it's time to kind of take the money out because it's kind of not going to go up that much before the expiration date? So is the premise of why we're talking about non-qualified stock options and when to exercise them. Does that make sense so far?
Sure. I think it's probably worth mentioning. We did a couple of deep dives into this area on the differences, for example, between qualified and non-qualified stock options, or basically ISOs, right? Versus non-qualified stock options. But do you want to give just a sentence about that and then say
no?
One has a tax benefit, one doesn't, something like that?
Incentive stock options, if you exercise and hold for a year and 2 years from grant date, you can get long-term capital gains.
Right.
With NSOs, they're non-qualified or non-statutory stock options. You can't get the long-term capital gains from exercise price to sales price. The other big thing that comes up is ISOs, when you exercise under regular taxes, that's not a taxable event. It is under AMT, so that's why ISOs are very different. But with NSOs, when you exercise, the difference between your strike price, so your exercise cost, and the fair market value at time of exercise, that's called your bargain element, the spread, that is taxable as ordinary income. So I guess it's worth mentioning now, it's not a strict kind of guideline or rule of thumb, but the advice that seems to be predominant from kind of CPAs, tax professionals, and stock option professionals that I trust, I think that are better at this than me, with non-qualified stock options, with NSOs, because it is taxable when you exercise, most of the time, it doesn't make sense to exercise until you're ready to sell. It tends not to make sense to exercise NSOs and hold on to those for the future. So if in our example, we exercise costs down here, sales price is a little higher, or sorry, exercise date, fair market value exercise a little higher. That's the taxable amount, difference between fair market value at exercise and your strike price. If it stays flat from that future point, if you were to exercise and hold, you paid a bunch of taxes, but there's no gain on top of that later. So you're only trying to get long-term capital gains if you're exercising, holding, and then it goes up even further. But the money that you had to pay on taxes at the time of exercise creates an opportunity cost that you would have rather had that invested. And so trying to exercise and hold NSOs, hoping that it goes up even further to get long-term capital gains after paying that tax bill is worse than just holding the option until that future date when you would have had the higher long-term capital gains. You'll pay ordinary income taxes, but the opportunity cost of the taxes you paid at exercise would have been growing as well.
Mm-hmm.
So most of the time, for most scenarios with NSOs, we don't want to exercise and hold. We want to exercise and sell. And therefore, when we have the option, we're going to wait for exercise and hold on to the option until we're ready to sell and cash out on the option. And that allows us to, one, kind of the opportunity cost of the taxes we would have paid, allows that to continue to grow. And two, we pay the taxes from the proceeds. So we don't need any outside money to pay the taxes on the exercise. We can use the sale proceeds themselves to pay the taxes on the exercise. Mm-hmm. So taxes on NSOs, are we good there for right now?
I think so. So basically, we have something called the ISOs, and they have some sort of preferential tax treatment. But this is not about that. This is about non-qualified stock options, where there isn't this preferential treatment of taxes. What this effectively means is when you go ahead and you exercise, you're going to have a big tax bill. That's going to be not at some sort of preferential rate, but it's going to be at basically your marginal income tax rate, for not the entire amount of the price, but basically the difference between the fair market value at the time that you exercise minus the strike price.
Yes, but in practical purposes, if you're cashing out the option, it kind of is the entire value, because when you do, so that's actually with NSOs, when you exercise, if you're going to exercise and hold, you also have to pay the exercise price. So you have to put the money at risk to buy the shares,
right,
and pay taxes on that bargain element.
Yeah.
Okay. So with a cashless, so that's a good point that I should have mentioned. That's another reason why it doesn't make sense to exercise and hold NSOs, because you have to pay exercise costs plus taxes, even more money out of pocket, for not enough gain that, or at least the gain on long-term capital gains, you would have gotten that anyways. So you could cash out, buy something else, or even buy the same stock and choose to get long-term capital gains that way. So when we talk about a cash out of NSOs, you're only getting the difference between the current stock price and the exercise price because they're going to kind of do the math for you. If your exercise price is $200, the stock is currently $500, they will only give you $300. So like you can cash out, they'll give you $500 for the current sale price minus the $200 cost to exercise, and then they charge the taxes based on that $300. And so you would get your net amount anyways. So it's, for most practical purposes, when you look at the value of the options, they're already subtracting that exercise cost.
Right.
So, and so the cash that you get is what is taxable.
Yeah, because it's all the gains, and
correct.
It's essentially all at your marginal income tax rate since they're not qualified.
Correct.
So then, actually, I don't see any reason why you would keep them and hold unless you really wanted that company stock.
Sometimes there are for certain executives holding requirements. They have to have a certain number of shares to be a high enough executive at a company. So there are reasons why they would want to hold those shares. And you get situated like if they've been there long enough, if the options were about to expire, but they need to hold on to the stock, then they want to exercise before the options expire. So there are reasons in edge cases, but for most people, most employees, if they have NSOs, you probably want to wait until you're ready to sell before you exercise.
Right. Okay, that makes sense.
Okay. So now, with options, there's a few really, really good benefits. Really kind of makes them really worth it. One is that you get to wait and see what the stock does before putting money at risk. You don't need to buy the stock and then hope it goes up. So you have time to wait and see what the stock does before putting any of your own money at risk. It's a little different for Netflix specifically because those employees are buying the options. But once you own the option, you get to wait and see. And if you're granted options at a publicly traded company elsewhere, you don't need to put your own money at risk. So you still get to wait and see and get the benefit of the upside. If it goes up, you have a really big tax bill, but you never put your own money at risk. If it goes down, you just never exercise and you haven't lost anything.
So are you saying that the Netflix employees did, though, have the opportunity to purchase the options?
Yes. Again, that's I wrote another article about that. It's pretty complex, but yes, it can purchase options at 40% of the current stock price. That allows them to purchase 2.5 options per every instead of one share.
Okay.
So that's one of the high risk, high rewards that makes the program kind of interesting from a academic perspective, but really high risk, high reward because they are putting their money on risk. But hopefully that's not the point of today's conversation.
Okay. I just have to say one thing that flashed in my mind is you could buy those options on the public market as well. So there might be some sort of arbitrage opportunity there.
No.
Not those specific ones, but close proxies of those options. No.
Because these are 10-year options.
Oh, okay.
And everything on a public market would be 2 years or less.
Okay.
So the ability to get 10-year options is one of the huge values that comes into play because you have more time to see what happens. So employee stock options, that 10-year expiration is pretty standard, and that's also really valuable. On a public exchange, you can't find anything farther than 2 years out.
Right. You could go over the counter for something like that, but then it'd be like a one-off.
Yeah, you'd have to find a market, and I guess if the stock option plan gets big enough that maybe someone could create that market, but I guess you could technically write a 10-year option if you wanted to, right? You just write a custom contract.
You could. I mean, when I was in the options business, yeah, we used to create contracts all the time, and it's up to you to manage your own risk, right? So,
Yeah.
but we generally didn't do anything over a year, just because.
Yeah.
Nobody wants to wait that long.
So that's the big difference. I don't think I'm probably calling it, there's no public market for 10-year options.
Right.
And I don't think anyone would want to write options for 10 years. So that is one of the unique things about the Netflix plan.
Okay.
But the 10-year time frame is pretty common with most employee options. So most employee stock options have a 10-year time frame. And again, that gives you more time, more years to wait and see what happens. So kind of for right now, for today's conversation, we're ignoring the cost to the Netflix employees. And for any employee that has non-qualified stock options in a publicly traded company, so they could cash out whenever they want, it's how do we decide when to do it based on stock volatility over the years. Okay, so that's kind of our premise.
Right.
NSOs in a publicly traded company, you could cash out, but we have the time to wait and see what happens. And so as our options become more valuable in the future, when do we cash out?
Right. So you have a decision you get to make, but when you do make that decision, you're likely going to pay a good amount of tax if it's a gain, and you want to time that appropriately because you're likely going to sell based on this strategy as well.
Correct. And so this is one like, yes, you want to pay a really big tax bill because it means you made even more money. So you're always going to benefit and get more whenever the stock price goes up. Your tax bill will also be bigger, but you always made more money.
Right.
So yes, you hope that you have a really, really big tax bill because it means that you made even more money.
Right. So this is the tax bill maximization strategy.
Yes, in a way it is. Yes. Okay. Even though now that you say, like, I'm trying to think, like, could you break it up into a couple different years or 2 different calendar years to maybe minimize it a little bit? And I don't get into that at all. So we'll just say it's a tax bill maximization strategy. I like that.
Okay.
So again, with options, one of the big benefits, you have time to wait and see what happens without putting more money at risk. Okay. The other component is the leverage that options provide. Okay. So I have a quick handy chart here. I'm going to share my screen. Okay. So here's my simple example. I'll talk it out loud for our podcast listeners. If you have a option to buy a stock at $1 and the stock is currently at $2, you have $1 worth of equity in the option. If you were to cash out, you get $1. It's 2 minus 1. If the stock goes from $2 to $3, that is a 50% growth in the stock. But your option value, the equity of your option, has gone from 1 to 2. So the $3 stock price minus a $1 exercise price. And so you've seen your equity value double. It's 100% rate of return. So when our strike price is half of the current stock price, our leverage is double. Okay. This stays there even as the stock goes up. So if we have, again, a $1 option, the stock price is now $3. If it goes from $3 to $4, we've got a 33% growth of the equity of the stock if you were to hold the stock, because we gained $1 on $3. Our option went from $2 to $3. So 4 minus 1 equals 3. So even though it was a 33% growth in the stock, we got a 50% growth in the equity. It's an inverse fraction. So again, this is the idea of how the leverage that stock options provide. And if at the beginning, if the stock price equals the exercise price, your option's worthless. It's worth 0, because if you were to cash out, you don't get anything. You have to pay the value of the stock. I don't say it's actually not worthless. It's just there's no monetary value
There's no
because it actually
intrinsic
I
value.
mentioned it.
Right.
There's no in the money value, but there's still some value to the option. But the way the math works, because it's 0, you divide by 0, so the leverage is technically infinite. It's in a divide by 0 situation. But it helps you understand kind of as the stock price goes up, the closer the strike price or exercise price is to the current value, the more leverage we have. As the stock grows away from the exercise price, so now if that stock is $10, our option value is still 1, our strike price is still 1. If the stock goes from 10 to 12, it went up $2 on 10, so we got a 20% growth. But our equity went from 9 to 11. So that was actually a 22% growth. So now the farther the stock price gets away from the exercise price, the less leverage we have.
Right.
And so we're no longer getting as much benefit from the leverage of the option.
So one way we kind of see this, when we in just the option pricing world, is this notion of moneyness and how far you are away from moneyness. So, for example, when you're at the money, that in your situation sounds like you have a large movement. And well, specifically at the money is basically your strike price is the current market price of the option. So, the $1 is the market price. The amount you pay is the amount that you have. And in your situation, you have a very high amount of leverage, meaning in your case, you said it was infinite, but very high amount. But as you get more in the money, meaning as the stock price goes up, the incremental amount that the stock price would go up from there decreases your leverage even more until basically it approximates the leverage you get from owning the stock itself.
Exactly. And that's the right concept, is that if you get far enough away between strike price and current stock price, the returns are almost the same between the stock itself and the option.
Right. You're so far in the money, you might as well hold the stock.
Correct. Exactly.
Right. Okay.
So we now have leverage with our option. That's kind of one of the big key components. So this would be a reason why we want to hold on to the stock. And just the basic concept here is if the leverage is high, so our strike price is close to the current stock price, hold on to the option. If the leverage gets low, then we can look to exercise and or sell. And based on our prior recommendation, we do both. We exercise and sell, or a cashless exercise or cashing out the option. Based on as much knowledge as I can gain about stock options, conversations with other advisors, attending conferences, speakers by stock option experts, it does seem that if you can get the leverage under 40%, that's probably a good indicator to be ready to sell. So the idea here is like if our stock is 200 the strike price is 200, stock price is 500. In my previous example, 200 is 40% to 500, and that's why I kind of use that. So if it gets over 500, in that case, we probably could be ready to sell. And the idea here is our upside on the leverage is less, but if the stock comes down, we're actually going to kind of increase leverage on the downside. And so we've gotten enough upside already that trying to get more just from the leverage component isn't worth it. That we've gotten enough already. The downside risk starts to outweigh the upside risk.
Right, because as we have noted, the farther up it goes, the more it just starts approximating the stock, and at that point, you could just own the stock and have this equal amount of upside and downside, whereas the option, the downside ends up being too great to hold on to that option, given
Correct.
that the upside gets squished the more higher the stock goes.
Correct, because our leverage again changes. So we still have some leverage. So here, if the stock gets to, even this example, right here, if we have a $1 strike price and a $4 current stock price, if it goes down, so if it goes down from $4 to $3, that was again a 33% loss on the stock value, but a 50% loss in your equity value of the option.
Mm-hmm.
So it works the same. The leverage is not only on the upside, the leverage also amplifies your downside return. And so that's why when we get to about strike price is 40% of the current stock price of the fair market value, from a leverage component alone, that would probably be when we're ready to sell.
Mm-hmm.
Okay. So again, because as it goes up further, our upside benefit is going to decrease, but we still maintain a decent amount of downside amplification.
Mm-hmm.
So again, about 40%. If the strike price is about 40%, and that's not a hard, fast rule. It's just it's enough of a rule of thumb to be a good guide in conversation. That this is one indicator that we'll take into consideration as part of your overall financial picture. Concentration risk is also big. So that's actually time to kind of pause here. And when we look at options, especially for public traded company, if it's in the money and you're looking to buy a house, go ahead and sell the option. We don't need to wait until it gets high enough. If it's in the money and the company's, this grant or this option makes up 90% of your net worth, let's sell some of it. Let's cash out some of it. So there's other factors for each individual that it's okay to cash out and pay the taxes, even though we're giving up some of the upside.
Mm-hmm.
So that's why I say we're kind of ignoring those other factors for today's conversation.
Mm-hmm.
You are already bought a house, you're saving well into your 401k. This is kind of extra money that you're trying to make a reasonable decision around, but there's no particular need for it. Mm-hmm. You don't have kids' college bill coming up in the next year, and this is the money that's paying for it. Just, I have this option. I had it for 2 years. I have 8 years left. It's gone up a little. Do I sell now or do I hold on to it?
Right. So basically you're saying if these funds are already for retirement, meaning you're going to take that money and the proceeds and still just put it into your retirement account anyway, there is a sweet spot to consider where if you find this 40% sweet spot, it might be a good opportunity to diversify, meaning get out of that position, pay your taxes, and then move that money into, your retirement portfolio. And that way it's not concentrated in your company, but you got a good bang for the buck out of the option itself.
Correct. Yep. So independent of other factors, if we're just looking at the leverage, that 40% is a good kind of indicator. Mm-hmm. The other big component when it comes to options, especially when it comes to pricing and the values, is the time value. So earlier, when I said if the strike price equals the stock price, there's zero in the money value. In this case, the moneyness is zero, but you have 10 years to wait and see what happens. That's a lot of time. And again, you don't need to make any action. And that time to wait and see is worth something. But in our example, if let's say our leverage was at 45%, okay, we haven't quite got there, but the option expires in the next 3 months. Here's an example, like, okay, we could wait 3 months to try and see if the stock goes up a little bit more, there's so much stock volatility in the short term, your risk of losing money in the next 3 months is so high, just cash out now. And it's kind of, if the option expires in 1 year, again, you could see stocks go up and down by 50% in a year. You could actually see company stocks, single company stocks, go up or down by 90% in a year. So single company stocks are already really risky. And so there's a big difference between if we have those 10 years to wait and see what happens versus we only have 1 year to wait and see what happens. And so it's conceptually, okay, what we also don't want to do, okay, this is a realistic scenario, is we don't want to be forced to selling everything in that last year. Okay, there's too much risk both up and down that it's hard to plan around it. We're just kind of hoping to get lucky. So in the last few years, we probably want to have a plan for how much to sell and when. So let's say we're at like 50% leverage. Okay, strike price is half of the current fair market value, but we're 4 years away. Like, okay, now it's like kind of like it's not imminent, but we're going to keep getting closer. If we keep waiting, we keep getting closer and closer. So having some plan of, okay, if our leverage is 50%, maybe sell 25% of our options. And then if it goes up to a certain price, we sell half of our options. If it goes up to a higher price, we sell them all. And so having a plan a few years out for how much to sell at different prices, and acknowledging if we hold on to it here in year 8 and then it goes down, well, we have to sell it anyways. So we took on that risk and we lost, but we don't want to be pushed where that's all of our options, all of our cash value in the options is just waiting. And so again, with the leverage, the basic component, if the leverage is high, hold on to the option. If the leverage is low, feel free to sell. And 40% is that kind of number. When it comes to the time value, lots of time, let's go ahead and wait and see. Little time, develop a plan for how much to sell. And like, you don't want to go wait too late, but it's because it's going to be each individual situation. You could sell half in year 7, half in year 8, unless it drops to a certain level. Then like, we'll see if there's a reversion to the mean. That can be an idea.
I can even see that, let's say you're not quite at that sweet spot of, that 40% number. Let's say you are at the 50%, you're a few years out. However, you realize that you're currently in like the 24% tax bracket, and you can fill that up, with another 100,000 and not cross over into the 32%. So why not do that for the next 4 years rather than just waiting till the end and then getting a definite 33% on everything?
That'd be another great example. Yeah. I this is more gut feeling. I think the stock volatility risk outweighs tax brackets. I would say because there's also a decent number of employees at tech companies that are offering options have incomes that will put them into those higher tax brackets, especially if it's a dual income household. So there's less opportunity for that, but that is a great example that it's more personal planning and your individual situation than it is generalized advice. So that's why the numbers kind of matter less to the individual, but the concepts are still important.
Also just kind of stepping back a bit, whenever I think about pricing options, it does have two components to it. The price of an option is the intrinsic value, where you do take that bargain element, right? You take the difference between the market price and the strike price, and then you add in the time value, which is the second component in your decision. And that is theoretically the fair market price of how much that option should be worth. And
Yes.
these are basically breaking down the decision into the two components and seeing how it fits into the overall picture of whether you want to keep this option or not.
Yep. Okay. That's exactly, I appreciate that segue, because that's exactly what we're going to get to next, is we can quantify those two values. How much is in the money, and we can quantify the time value of the option. So, okay. This is where I can easily get really wonky, so I'm going to need you to kind of help rein me in a little bit.
Okay.
This is Netflix stock over the last 5 years. Okay.
Okay.
So again, 2000s, it was about $500. Okay. End of 2021, it got up to almost not quite to 700.
To be clear, that's the 2020s. It was 500.
Yes. Sorry, did I say 2000s? Sorry. Yes, yeah. I did that again. 2020s, about 500.
Okay.
End of 2021 got almost to 700.
Okay.
Okay. Then it drops all the way down from 700 or 690. I think it got to a low of like 179, somewhere in there.
Yeah.
Okay. Or 175.
Yeah.
So this is an example. Single company stocks are really risky.
Right.
Okay. Now, again, there's upside to that risk, going from 272 and kind of tripling in 3 years. I don't think the S&P 500 is going to triple in 2 years. I don't know if it's ever done it quite that big. But we also have this downside of a 80% loss, 75%-ish.
Yeah, 70 to 80.
From peak to trough.
Yeah.
So single company stocks are really risky. But what happened is people, because it's an employee benefit during open enrollment, employees of Netflix, they sign up at the end of 2021. How much are you going to put into options in 2022 from your salary?
Yeah.
So kind of like, because they'd signed up for us, they were buying options every month throughout this year. It meant that they were buying options that had a strike price all the way down in the 170s. Based on the timing of the month, I think the lowest one was 179. And I'll use that as my example. So they had options with an exercise price of 179. Then in this year, got back up over 300. Okay. And this is where I started getting the questions from some of my clients. All of these options purchased in 2020 and 2021 are underwater. There's no reason to exercise them. You're just losing money. But you can, again, hold on to them. Let's see, can we go longer? Okay, we have 10 years. We have until 2030 to make a decision. So we'll just hold on to them, wait and see what happens. But these options...
To be clear, though, these are options that they're granted, but they're paying money for, and they're purchasing at the money 10-year options.
Correct. But they get 2.5 options per strike price. So the cost of the option is only 40% of the current stock price. Again, that's a different, longer conversation. But it's just, I want you to understand, like, they have options with a $500 strike price. They also now have options with a 179 strike price.
I don't know if we need to have this conversation at some point, but my brain's already thinking, well, okay, let's figure out the fair market price of that option and see if it's under or overvalued based upon volatility estimates of the stock.
Okay, so this is the math I've already done.
Okay.
Earlier, the stock volatility was up around 50%. Now, I used a 37% volatility. There's been enough both implied option volatility. Also, we have a longer track record. So for this stock, as of right now, I'm using 37% volatility.
Okay.
For context, S&P 500 is usually 15 to 20-ish. Some smaller startups or newer, they can be much higher. So the IPO for Netflix back in 2002. So like when the stock was going up here, volatility might have been as high as 100, but we started getting enough track record over time and enough years that I think when I first did my analysis, volatility was about 50% here, and now I'm going to say it's about 37%.
See, the interesting thing about that volatility estimate is it's an annualized number, but Black-Scholes assumes it's constant for that 10-year period. So the chances of it staying that high for 10 years is quite minimal.
Yes, but it's not the conversation for today. Because
all right, you got my brain already in an area.
Okay, but you're right. We can use I use a Black-Scholes calculator because it's a publicly available tool.
Yeah.
And we don't need the precision that this tool provides. It really is more conceptual.
Yeah.
If it was, so think the stock price got up to about 360. Okay. Exercise price is 179. Again, these were purchased 2022. It's still 2023. We still have 9 years to wait and see what happens.
Yeah.
Okay. I used a risk-free rate of 3%. That might be a little higher. That's also, this changes over time. So that's another limitation of Black-Scholes. And volatility of 37%. Okay. This tells us that the option is worth $247.
Mm-hmm.
Okay.
Yeah.
So if our option's worth $247.
Okay. Can you make that bigger for the viewers? Like zoom in?
Probably.
It's view. Yeah. Or you see the bottom right? Yeah.
Okay.
Okay.
So these are a few examples. Exercise price was 179. Stock price was 360. Black-Scholes was 247. Okay. So I want to add a couple things in here to make our math, to help our math. So we know that the stock price is 360 and the exercise price is 179. So the in the money value is $181.
Okay.
That's our kind of our cash out value per option.
Yeah.
Okay.
Like intrinsic value or
in the money.
Okay.
In the money. Okay. In the money. Then that tells us if the option itself is worth 247 and the in the money value is 181, then the time value, because we still have 9 years left,
right,
is the difference between the Black-Scholes value and the in the money value.
Mm-hmm.
So the in the money value, or sorry, the time value is $66. So Black-Scholes was 247. In the money was 181. So our time value is 66.
Yep.
Okay.
Okay.
This is now, there's a company called StockOpter. They have done a good job analysis, and it tends to be kind of agreed. We can actually apply what they call their insight ratio. I think they have a trademarked name for that, but we can now compare our time value to the in the money value and get our insight ratio. And what we're doing here is, I think I summarized it all up for one thing, but we're going to do the, it's how much the time value divided by the Black-Scholes. Okay. So we have E3 divided by C3. For podcasters just listening on the audio, I'm doing an Excel in real time. Okay. But when we divide our time value from our total option value, that Black-Scholes calculation, this is a percentage called the insight ratio. This allows us to
build of the price that's attributable to the time value of the option.
Correct. Exactly. Exactly. Thank you. Say that again. Just rephrase it. Say it again.
This insight ratio is the percent of the option price that's attributable to the time value.
Exactly.
So 20% of the option, 27% of the option price is for time value.
Yes. And so we're now able to calculate how much is due to in the money value. So in this case, it's going to be the inverse. So 73% is in the money. Time value is 27%.
Yep.
And so what we can do is compare, we can kind of change our variables. Okay. And similar to the 40% leverage number, a guide would be a 20% insight ratio. The idea here is if our time value goes down enough, and most of the option value comes from in the money, from the moneyness, that's another indicator that we should probably sell.
Okay, so it's another rule of thumb saying you've squeezed enough juice out of this lemon, it may be time to switch to liquidate.
Correct. And so I gave two examples here. So the kind of two ways to think about this. Either the stock price goes up more and we have the same amount of time left. And so the question is, how much does the stock have to go up for the in the money to outweigh the time value? Or how long do we have to wait at the current stock price where our in the money has our time value has gone down enough that the in the money value outweighs it enough? And so in this example, if we have the exercise price at 179, the stock price would have to go up to, and we kept the 9 years, so it's still 9 years away. The stock price would have to go up to 435. Okay, and we get an insight ratio of 19% to get under that 20.
So at that point, the stock price has gone up enough such that even though there's 9 years left, you've squeezed enough juice out of the stock so that it's worth it to sell it based on this heuristic.
Correct.
Okay.
And kind of this is not necessarily coincidental, but this is why math lines up. In this case, our exercise price divided by the stock price is 41%.
Okay.
So it lines up with the other heuristic as well, where the leverage has gone away enough and it's gone up enough that we can kind of now ignore the time value. So if we change this 9 years to 10 or 11 years, that's not going to change the value of the option by as much. It really is driven by the stock price increase. And so that's another combination. If you're still really, really far out, but your stock price, so again, there's two ways to think about it. The exercise price is 40% of the stock price. It also means that the stock price is 2.5 times the exercise price. We already got a 2.5x return on the stock.
Right.
So that's the indicator of, okay, this has now gone up enough that we can kind of ignore the time value, even though we have 9 years left. Okay. Or if the stock price stayed at 360, again, all these numbers are a couple months old because this is when I actually wrote the article, but we can actually redo it again. But if the stock price is 360, how I did a trial and error, how far do we have to wait until the insight ratio gets below 20%? And we had to wait until there was 5 years left. So another 4 years to go. And that meant that even though our in the money value stayed the same at 181. So again, it was a stock price of 360, exercise price 179. In the money value is 181 in both scenarios. We have 9 years left. We have 5 years left. The risk-free rate stayed the same. Standard deviation stayed the same. That's another reason why it's okay to make any kind of reasonable assumption on the risk-free rate and the standard deviation, is that we don't need the precision. We're simply comparing, kind of changing one variable at a time. Either time or stock price. So in this case, the in the money value is 181 for both of them, but the time value, because we only have 5 years left, has dropped from 66 down to just under 40.
Right.
Which means our insight ratio is now under 20. So this insight ratio is a really good combination of the value, the moneyness going up enough, that leverage idea, or the time value has shrunk enough that we can be ready to sell. And these heuristics, the 40% leverage or 20% insight ratio, kind of play out well enough with most individual situations. So again, if the stock price is 360, we have 5 years left. That sounds like it's a good time to develop a plan for what to do. You'll also see that was for only the options with the 179 strike price. They also have options at 200, 220, 300. They have options at 500. They have options up in the 600s. And so using this, again, the Black-Scholes is a simple calculator, but it works for our conversation. But understanding the leverage and the time value, we can start to decide not only is it time to sell, but which options do we sell and when?
Right. So basically, for each option purchase, you should understand both heuristics.
Correct.
The 40% and the 20% heuristic for that particular option purchase decision on whether to sell it or not.
And so prior to 2020 and 2021, the Netflix plan still existed where they would actually grant employee options on a monthly basis. They couldn't put their own money at risk quite the same. So it's a different change in the plan. But there are employees who have been at Netflix for longer than 2020. So they've been there since 2017. And now, even though they'll have options granted around 250 or 270, but those are 4 and 5 years old. And so I think we go back in a little farther. We have to go back, not quite. I think it's I think I wrote this down. Anything granted probably about 2017 or earlier. So if we look at the Netflix stock price in 2017 was around 100 to 200, kind of 140 to 200. So there we have that combination of it has gone up enough, even at we lost out on this, but even at the 360-ish, 330, we have both it's gone up enough and we have only 4 more years before they expire. It's probably okay to sell those options. Anything from 2018 to 2020, again, so there's some value there for some of them, but the leverage is still too high that we want to hold on, and we have more time, so we wouldn't sell these yet. Anything in 2020 and 2021, they're underwater, so we wouldn't sell these. But options from 2022, while there is some in the money value, that does not outweigh the 9 years of time value that we still have. And so each of these from 2018 to 2022, we're choosing not to exercise and sell. We're choosing to hold on to options, but it's for different reasons at each point.
Right. Yeah. And obviously, if the chart looked completely different, then you'd be doing completely different things depending on, so it really does depend on what's going on with that specific purchase.
Yes. So it's again, everyone's situation is different. Kind of how long you've been at the company is different. What personal need, personal situation, personal taxes. But by thinking conceptually that it's not just in the money value, but also time value, that allows you to start planning on when you should look to be selling options. 40% on the leverage, 20% on the insight ratio. Those are just heuristics. If you wanted to be more conservative, you can sell them earlier, say they're higher leverage or higher insight ratio. If you want to be more aggressive, it's okay to go lower than those numbers, especially if the concentration risk is not too high. So there's lots of things, but those are good numbers that if you force me to say what number should we go at, that's like the starting point of the conversation. But that allowed me to recommend to my clients who had been at Netflix for a few years, they have options priced at 179. We are holding on to them, and here's why.
Yeah, that makes sense. It's like you're giving the guide for like the center path, but then depending on how risk averse or risky you want to be for, and also depending on, of course, all of your individual nuances to your personal situation. You may deviate that, but at least it's a starting point, and then it can lead to where the specific solution makes sense for your situation.
Yep. And what it does, it removes that feeling of, oh, the stock price has gone up a lot. Should I cash in now?
Right.
Like, maybe. Why stock price going up is not enough to be the sole determining factor of yes, you should sell.
Right. There was Buffett quote time.
Okay.
What did he say? The stupidest reason there is to ever buy a stock is because it's going up.
Oh yeah. I think that's more of a buying decision. I was like trying to get overvalued.
Just take the opposite of this. Yeah. So the stupidest decision to make for selling a stock is because it has gone up.
No, I'm gonna say the stupidest reason to sell stock is because it's going down.
You're right.
But it's.
I think the main point is it's a lot more complicated than that.
Yes, and actually, what it plays out is almost a preempting regret idea of the feelings that you have, especially for employees who have company stock. If they sell it and it goes up, do they feel bad that they sold too early?
Mm-hmm.
And if they hold on to it and it goes down, do they feel bad?
Mm-hmm.
It's understanding why you would be selling or holding that allows you to preempt those feelings. Right. If you sell and it goes up, you're okay because you knew why you sold.
Mm-hmm.
And if you hold on to it, it goes down, you feel okay because you knew why you were holding on. You've had the conversation of you can still be financially independent 10 years from now, even though the stock went down. Like you still like this. That's why all those other factors come into play.
Mm-hmm.
And by having a good plan in place, it allows you to really own the decisions when it comes to things that are outside your control, especially with stock volatility.
Right. This makes a lot of sense, Aaron. I think I learned a ton this conversation. So, wow, good stuff.
So I'll have to figure out. I'll include a link to the insight ratio. They have a good job of showing off examples as well. All the Black-Scholes calculator. Again, we've talked in the past. So there's better calculators, but we don't necessarily need better calculators. We just need to compare changing time versus changing stock price.
Right. And those are the two key drivers that build into the actual option price itself. So it does make sense.
Yeah. So I'll include a link to my article as well. But it's again, if you strip the concepts, leverage and time value, and both of them matter, that's how you can make a good decision when it comes to when do we sell options? When do we sell the options that we already have?
Good stuff, Aaron. Well, anything else to add, or do you think we covered enough ground?
Did I too deep? Did I get too wonky, or was it?
I think we're good. You excited me at least. So. Good job on that.
Now you want to go into like the Netflix plan specifically, don't you?
Well, I'm tempted to, but we'll need to talk offline on where we go with this.
Okay, I've written about that as well, but yeah, that's it might be too esoteric, or just esoteric enough to spawn conversation.
Right. Well, we'll see, I guess. Stay tuned.
Okay.
Well, thanks everybody for listening. If you enjoyed this conversation, do spread the word, do like, share, and subscribe. And thanks.
Bye.
Bye.
We appreciate you joining us today for this episode of the Mind Money Spectrum podcast. Be sure to visit mindmoneyspectrum.com to access the entire library of episodes. Remember, it's not black and white, but the wide spectrum of gray area where you get to pursue the freedoms you want in life. Opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested in directly. Have a nice day.